For this video, we want to answer the question, how can I avoid big bank mortgage penalties? So let's compare the penalty formula of the big 5 banks versus monoline lenders. Now, these calculations are estimated numbers and penalties may vary from lender to lender. Let's use our real-to-life example. Here's Jesse's story. As a first-time buyer, Jesse was very excited about a fabulous big bank employee pricing mortgage tied to a 5-year fixed rate that offered a 2% discount. Since the bank's posted rate was 4.64%, a 2.64% mortgage rate made Jesse very happy initially. The bank failed to mention the penalties involved in breaking a fixed-rate mortgage, which can happen by simply selling her first home. Since we know that in Canada, the average life of a mortgage is 3 years, Jesse's story is very common. Jessie learned the hard way that her penalty to get out of a 5-year fixed-rate mortgage is significantly larger than the simple 3 months penalty her bank rep told her she would most likely pay. Now, Jessie wants to know, how do you calculate the penalty? Big bank answer: anytime you break your mortgage contract with any lender that is a fixed rate, you will be subject to either a 3-month interest penalty or IRD, whichever is higher. What is IRD, or interest rate differential? Well, in simple terms, it is the difference in the rate between your contract rate and the rate of the term you have left over at the time of discharging your mortgage. Bottom line, with the big bank, Jessie had to pay the interest differential. The details Jessie wishes she knew at the beginning of her story. On $400,000 with 2% discount from the posted rate, her balance is now $364,653. Since Jessie has 2 years left on her term, the bank will calculate the rate of return on the current posted 2-year rate of 2.84%. Now, the bank will take the 2% discount, which previously made Jessie happy, off the posted rate of 2.84% equals 0.84%, and subtracts that from her contract rate of 2.64% equals 1.8%. This is how the big bank will calculate the penalty. $364,653 times 1.8% times 2 years remaining in the term equal $13,127.50. That's a big penalty. The big bank will also give Jessie options of blending or extending the mortgage. However, the rate will get blended with the penalty, another hidden cost. Now, let's turn the story into a happy ending. If Jessie spoke with a mortgage broker and used a monoline lender, her penalty would have been only $2,918.97. That's a savings of over $10,000. Jessie would have originally received a 2.69% mortgage rate. Her outstanding balance after 3 years would be slightly higher at $364,871. The best 2-year rate at the monoline lender would be 2.29%. The penalty would also be either 3 months or IRD. 2.69% minus 2.29% equals 0.4%. times $364,871 equals $1,459.48 times 2 equals $2,918.97. It pays to know all the facts the banks don't tell you. YourMortageYouWay.ca is dedicated to providing you with all the information you need to make a well-informed decision on your mortgage financing.
Thank you for watching this week's Mortgage Minute. For more information, visit our website at YourMortageYourWay.ca, where you can find links to all our social media. Sign up to our blog, follow us on Twitter, like us on Facebook, or subscribe to this YouTube channel to get helpful advice on what's important to you and your family's financial health.